And thank you, Tim, and good afternoon and or morning to all of you in Australia. I look forward to my opportunities to be able to come back when the borders are open again. Given that time's limited, I do want to encourage any of you that are viewing this opportunity to please go to our website at ottoenergy.com, where you can learn a lot more about the company, its strategy, and its ongoing performance. But over the next 10 minutes, what I intend to do is to start with exactly as Tim said, to give you a brief overview of the track record and experience of the management team that drives the Otto Energy story, to give you a sense of the nature of our focus in the Gulf of Mexico, onshore and offshore, to briefly touch on our strategy, both fiscally and strategically in terms of leveraging our existing base and growing the company, to give you a sense of the strength of the company through its underlying balance sheet and cost basis, and then to finish with an overview or wrap up again of a summary of the company's performance. Next slide. As required, or as you can see here, we have a management team that has a significant level of experience. That combined with the 4 members of our technical team making up the 8 persons who represent Otto Energy. We have over 230 some odd years of global experience, but particularly predominant in the Gulf of Mexico, onshore, offshore, and US. With that management team, next slide, please. We've been able to focus over the last 5 years in building the company with its focus on the Gulf of Mexico. Why the Gulf of Mexico? 1, because of our experience base, and 2, because of the fact that it's a very mature basin, and yet it's still very prolific in terms of its opportunities that it represents, both onshore, in the shelf region, and in the deep water regions of the Gulf of Mexico. Each of these 3 areas continue to deliver significant discoveries and continue to deliver significant resources. The second reason to be in the Gulf of Mexico for us is that it's a fantastic place in which to operate. It has low royalty rates. It's got a stable fiscal regime. It's got a stable political regime, and with limited to controllable federal and state regulations in which to operate against. It also comes with an extensive infrastructure that allows us access to multiple markets, and in particular, the Gulf of Mexico and Gulf Coast bring a premium to WTI or West Texas Intermediate crude prices. So we therefore benefit in an uplift to the quality of the product that we're able to produce. Next slide. It's important to recognize that the strength of that technical team and management team have enabled us over the last 5 years to review a significant number of opportunities onshore and offshore Gulf of Mexico. From that, we've been able to evaluate individual prospect opportunities all the way through to companies. And from that, we've been able to capture 3 significant assets. Next slide, please. Those 3 assets represent both onshore and offshore Gulf of Mexico. South Marsh Island 71 was our first participation in a major discovery. It is one of the top 10 largest shelf discoveries in shelf offshore Gulf of Mexico in the last decade, and represents the cornerstone of the company over the last 3 years in terms of delivering its strength to its balance sheet. We subsequently participated in the discovery of the Matagorda County Lightning Field. It's an onshore gas discovery. Again, reflective of the nature of the quality of our technical and commercial teams' expertise, we were able to position ourselves to participate in what is another of the largest gas discoveries in the last decade in the Gulf of Mexico, Gulf Coast area. And then finally, we've just entered into an opportunity to develop in the deep water environment, subsea tieback called the Green Canyon Bullet Well, which came on in October of 2020 and is continuing to be optimized in its performance. These 3 assets represent, in all cases, we are non-operators, so we are partners with the operators who actually manage the day-to-day production, but it enables us to maintain a low-cost structure and continue to advance the opportunities to support the partnerships in the development of additional resources. Next slide, please. Not only are they significant resources, but they've been outstanding economic and financial successes. Shown here is the asset performance date track record for South Marsh Island 71. And as you can see, it's predominantly an oil field, and the Lightning is a gas field with condensates. GC21 is oil and gas. The combined success case for those three assets represents an IRR of greater than 86. An ROI discounted at greater than 2, a PV15 of more than $62 million, and a payout against the investments made in that of just under 4 years. So quality assets that are significant to our abilities to then leverage that in our balance sheet and financial performance to target growth for the benefit of developing returns for our shareholders. Next slide. Importantly, these assets also carry with them additional upsides within the fields, and that gives us an opportunity to continue to invest now that we've completed the investment in the initial infrastructure in the Gulf of Mexico or onshore. We have the fields, the facilities, the pipelines. We now can look at lower cost development of additional resources in each of those. And as you can see, underlying our 1P, 2P, and 3P reserve base, we actually have an existing developed resource base of approximately 9 years, and opportunities to continue to invest in these three fields, which will extend our producing economic life to out to 14 years going forward from an economic standpoint. Next slide. This is shown and reflected in terms of both the nature of our continuing growth and our abilities to add production on an annual basis, both past and present, as well as looking forward and on a forward-looking basis for 1 year. And coming with that is, of course, a lower capital requirement in which to develop that additional production stream and capturing those additional resources. The importance of that I'll come to in a few moments, because it obviously creates increasing free cash available for us to look at the next set of opportunities for growth that will enhance our returns to our shareholders. Next slide. So let's take a moment to let me share with you kind of the strength behind those assets and what they've created in terms of our balance sheet. Significantly over the past several years, which have been challenging for the oil and gas industry on a global basis, we've been able to leverage that period of time with the growth in production into significantly challenging the cost structure of the company, both in a direct lifting cost basis and an indirect G&A basis. We've taken our overall costs from the originally fully developed costing of $31 a barrel to presently approximately $17 a barrel. And against a backdrop of $64 oil pricing in the world, it gives you a sense of the margins that these assets are able to generate. Particularly important in this is that our actual operating costs are less than $8 a barrel. So the other $9+ a barrel is what we believe will be the investments made from a capital standpoint to develop those additional resources that I mentioned earlier, taking us from 9-year productive life to 14 years productive life. So our overall break-even cost, if we make no further investments, is $8 a barrel against a $64 barrel oil world. Next slide. As you can see, this, taking that increase in production on an ongoing basis, we have a small debt facility that's enabled us to be able to invest and develop those resources, which we continuously and are rapidly paying down. We owe $13.8 million remaining on our debt facility. And we have an additional source of funding that can be captured through those facilities for the potential growth opportunities. What it's attempting to reflect here is a simple fact that as we've lowered our cost, as oil prices have rebounded, we're creating a significant volume of free cash that's allowing us to take advantage of what is a volatile marketplace, but with significant opportunities beginning to come to the market in terms of future investments for capturing growth. Next slide. It's important, though, to reflect that we are being very disciplined, given that there is a significant increase in opportunities starting to emerge from individual prospects all the way through to company acquisitions. The importance of leveraging the strength of our balance sheet, our strong cash flow position, our limited to no debt remaining position against against our balance sheet on where and how we invest our money. And we've been very transparent and attempted to be very visible in the nature of the criterion that we're using to continue to evaluate prospects and opportunities to invest our shareholders' money to enhance the nature of the return that we're realizing. And that's shown on the right-hand side of this, where we're looking at opportunities with ROCEs of greater than 15%, ROEs of greater than 15%, discounted return on investments of 15% of greater than 25%, and so on. And what's encouraging is we're starting to see as the industry is emerging from what has been a very difficult 2 years, the quality of how people have used in companies across the board this time of limited investments to develop inventory and prospectivity, and are now looking for companies who have cash, who have strong balance sheets like Otto to partner with to develop those new resources across the Gulf of Mexico and onshore US. And we're well positioned to take advantage of that opportunity. Next slide, please. So bottom line, we have 3 outstanding assets that are delivering day in and day out, increasing production with lowering costs associated with those barrels that are creating the opportunity for us to leverage our free cash flow and our strong balance sheet to look at how we create value for our shareholders. It's being driven through looking at individual prospects all the way through to companies, but equally we're looking at how we might be able to leverage either the sale of Otto assets to acquire other assets with greater potential, or to merge ourselves with other companies of like size or larger, and ultimately with the intent to look at how we return to our shareholders the confidence that they've placed in us by investing in us to provide us the resources to be able to create that growth. Next slide. One simple and quick example of that is we took our acreage position in Alaska because we weren't going to be in a development mode. We had a 10.8% interest in a very large block of acreage. We were able to convert that with a pure explorer in Alaska, to the opportunity to translate that position into shares within that company, such that it allows us to participate in the future successes of that company's development efforts and activities. Plus, we've retained an override in the future development. And this is a way in which we can monetize assets that otherwise would be long life and high cost challenged to be able to be developed within our existing portfolio. Final slide. So bottom line, we're in the US Gulf of Mexico region because it is a mature and opportunity-rich environment. We have a management team and technical team that's extremely experienced and has a proven track record of being able to identify high-quality opportunities to invest. Our base is a balance between gas and oil, and it's all very high margins against the portfolio. It allows us, with that strong balance sheet, to continue to assess new opportunities and to continue to advance the development of the company from a growth perspective, which in the long term will provide significant returns to our shareholders. And with that, Tim, I close.
Thank you, Mike. Bang on time, much appreciated. A couple of questions here. You picked up some great assets in a prolific basin. How did you go about doing that, and how were they priced at the time, given the volatility in the oil price?
Well, the strength of our team is its experience with regards to the Gulf of Mexico onshore and offshore. And we did a screening of all of the most prolific salt domes, which are the significant areas of potential developments. And from that, it allowed us to high grade from over 100 salt domes in the Gulf of Mexico to 16. In those 16 salt domes, we identified companies who had captured opportunities, but were either capitally constrained in terms of their abilities to develop them. And we were able to then approach them with that opportunity to participate and or share in the risk and obviously the reward potentials. And that's led us to be in that strong position of being able to identify these types of quality assets.
And you showed a slide there reducing the cost of these assets and the cost of oil over time to you and increasing your margin. How do you go about reducing those costs?
Threefold. I think one, working with the operators of these three assets, the reality of the marketplace and its environment has created a cost synergies and cost opportunities in which we've been able to leverage the supply chain, and that's helped us to reduce direct cost. Indirect cost wise, we've streamlined the size of our organizations. I think like many companies have had to do, we've also streamlined, we've invested heavily on the front end in data to enable us to identify and prospect generate. Now that we have that data, we've had a much lower cost to actually further identify and develop and evaluate prospectivity on a go-forward basis. So overall, we've been able to focus on both our indirect G&A costs and to streamline those to the right sizing of the company. Given that we're a non-operator, we don't require a significant organization to manage those assets. But equally, we're able to leverage on the direct operating side the good work of our operating partners and ourselves to leverage the supply chain realities.
And Mike, we've got a couple more questions, but we've probably got time for one if you don't mind. And I know we've got an analyst online here. He says this is a strong story on development. Are there any available contractor resources to enact all your plans without delay?
So with regards to the supply chain in the Gulf of Mexico, it is a very mature basin, and there's a prolific variety of providers of services, from drilling services to completion services to infrastructure and pipeline development aspects. From a technical standpoint, in terms of resources for us to be able to leverage, we have, because of our experiences and both technically and commercially in the Gulf of Mexico, we have a long list of people that we can call upon to help support evaluating opportunities, to provide external peer assist reviews of those opportunities to ensure they meet our criteria and are consistent with the type of investment strategy we've developed.